Lovely. There we go, ladies and gentlemen. Thank you for bearing with me there with some audio troubles. It seems like they've been popping up more often than not. We use Streamlabs as our exclusive method of streaming to the millions, the Dylan Hoy experience. But let's continue on. Ladies and gentlemen, welcome to Christmas Eve. I hope you are all having a fantastic holiday week. Christmas tomorrow, Kwanzaa on the horizon on the 26th. Now, there were some developments in the markets and on Capitol Hill on Thursday and Friday, and a little bit on Saturday as well today, Christmas Eve. So let's break down what happened with that Santa Claus rally. On Wednesday, when we were on the midweek market recap, the Santa Claus rally was in full swing. And let's see what happened. The S&P 500 and NASDAQ closed higher but fall for a third straight week. The S&P 500 and NASDAQ composite rose on Friday but still posted a weekly loss as recession fears continue to batter investor sentiment. So it was not a fantastic week for the markets. That Santa Claus rally did not come in full swing like many were hoping. The S&P 500 rose 0.6%, and this is on Friday, while the NASDAQ composite added 0.2% to close at $10,497.86. The S&P 500 closed 176 points higher, or 0.5%. The major indexes oscillated earlier in the session after the core personal consumption expenditures price index, the Federal Reserve's preferred gauge of inflation, came in slightly hotter than economists expected on a year-over-year basis, indicating that inflation is still sticking despite the Fed's efforts to fight it. We're getting that full percentage Fed interest rate hike through 2023. They said this. So inflation is definitely still hotter than anticipated. And this was happening before these numbers came out on Friday. I mean, the price of food's still up 10%, and it's still rising. I don't care what these politicians are saying. Oh, we're bringing the price of food down. BS. Eggs are 40% more. That's a lie. So that's a lie. That was a full-on lie. Anyway, the S&P 500 ended the week down 0.2% for the week, posting its third straight weekly decline. The NASDAQ composite, meanwhile, lost 2% for the week. It is tech-heavy, and tech-heavy stocks are just getting absolutely battered. Also, for the third week down in a row, the Dow Jones was the outperformer, posting a 0.9% gain. For December, the S&P 500 has lost 5.8%, while the Dow and NASDAQ have lost more than 4% and 8.5%, respectively. Those are the biggest monthly declines for the major averages since September, and stocks are also on pace for their worst annual performance since 2008. Let's take a look at our handy-dandy trading view and see what's going on there. So, and again, this isn't a charting channel. This isn't a trading channel. And most charts in most cases, I think, are the finance bros astrological signs. It's definitely astrology for finance bros, but I like astrology and I like charts. If we take a look at the Dow Jones here, it's lying on some major or at least on the daily historical price levels and support and resistance zones. It does seem like it's popping off a little bit here. Maybe it's going to have a jump. I mean, but the thing with the inflation and the recession fears, totally get it and totally valid. Like we are full on living in a recession right now. Basically inflation's at its highest still in 40 years. But I mean, it's still Q4. I mean, dude, the amount of money that Americans spend on Christmas, I mean, Thanksgiving's one thing, and that was a month ago, but people drop a big old dime on Thanksgiving. Christmas, take the meal of Thanksgiving and then add presents on top. So this is when Americans shell out the most amount of money in the entire year. Like this week, Christmas Eve, and then you bring that back about a week. So from December 17th to December 24th, Americans drop fat stacks. So I definitely think that, I mean, maybe Q4 disappoints, but I definitely think that Q4 and how much money these corporations and publicly traded companies are going to be announcing in January once those Q4 reports come out. I still think that it will be stronger than the previous quarters. Will it be as strong as people are anticipating? I don't know. I can't tell you. But yeah, the actual spending habits of Americans for Christmas has not really changed. Like, people are still getting a bunch of presents, albeit maybe they're spending less on presents, but they're still getting a bunch of presents. So yeah, the markets are down from, like, obviously from a macro standpoint. And even looking at the weekly, it was a negative week. We didn't get a Santa Claus rally. The analysts were expecting a Santa Claus rally, but we ended up not getting that, and that's all good. Hey man, that's all right. That's all right. It's just a discounted place for me to be purchasing. I own the S&P 500. I dollar cost average into that in my retirement accounts, both my Roth 401k and Roth IRA. So again, and people say that I have the luxury of because I'm 20 years old right now. People say that I have the luxury of time, so these market corrections don't really impact me, and I totally agree with them. And they say it more as a negative thing when I say it's all good because you can buy these companies for cheaper if you're still buying them. And they get angry, and I say, hey man, that's all right. That's all right. Everyone the thing with these market corrections is everyone is biased, and what I love to see nothing but green days on the market. Of course, everyone loves more money. Everyone wants to see their investments go up always. But the thing is, nothing ever goes up always. There is going to be some downward movement. Are we possibly getting further downward movement? I think signs may point to so. The physics are catching up on the federal interest rate hikes. They're bumping interest rates even further. There's less consumer demand. There's higher inflation. And overall, like, the stock market was overvalued. So I'm not here to be the doom and gloom. Sell everything. Don't do that. Don't sell everything, please. That's not financial advice, but just don't live a fear-based, market structure. Don't base your life around that. But no, if we see further downward action, I'm just going to treat it as a dollar cost averaging opportunity. That's all you can do as such. That's all good. Now, speaking of dollar cost averaging, let's take a look at what the U.S. House and previously Senate ended up passing through for the federal government funding bill. The U.S. House passed a bill to fund the federal government for the rest of the fiscal year through September of 2023. The legislation now goes to President Joe Biden, who said he is eager to sign it into law. Overall, the legislation provides $772.5 billion for non-defense discretionary programs and $858 billion in defense funding. What makes this significant? Well, let's take a look at the historic defense funding numbers. Historic defense funding last 50 years. This is what threw me, man. This is what really got me. So if we just take a look at the macro charts or macro trends from 2015, so over the last 7 years, we've gone from $633.83 billion to, and this is just in 2020, $778.23 billion, and we are now at $858 billion. This is a 5% increase from where we were last year. And what makes this even more significant is this is the most we've ever spent on our military again. It's not going down. The funding is not going down. Like all of these politicians clamoring for peace and love, man. We need world peace, man. We need to de-escalate conflicts, man. They're not. They're actively funding the war machine. And let me make this very, very clear. I am a shareholder in Lockheed Martin for transparency purposes. I do own Lockheed Martin. I do own a military contractor. And they pay a hell of a good dividend, in my opinion. Emphasis on opinion. So yeah, let's make it clear. I do actively own, and I'm an active shareholder of Lockheed Martin, a military defense contractor, if not the biggest military defense contractor in the entire world. So going back to this, people, they talk about the peace and love and world peace stuff, and these politicians, they keep giving the war machine more money because this is how American imperialism is. Like, let's take a look at all of our military bases all over the world, U.S. military bases, because this is how we maintain our global hegemony. Hegemony? I think it's hegemony. I think that's how people say it. But this is how we, maintain control. Like, this has always been the imperialist method of doing so. So, dude, look at how many bases we have in Europe, how many bases we have in the Caribbean, all over Southeast Asia, all over Europe, all over the Pacific. So yeah, they're giving more money and these are just based off of actual countries. So if you go into here, like Germany has 148 bases. The United Kingdom has 58 bases. Japan has 53 bases. India has 36 bases. So they just need to keep funding this because this is what America does. Like, this is how we have superpower status. We have military bases in international countries, and we basically defend the countries. I mean, other countries have standing militaries, but I mean, I feel like it's not controversial to say that the United States has far and away the most powerful military in the entire world. So it's not surprising that they passed another funding bill that increases the funding for the military again. If we also and speaking of military, this funding is not going to our military. Instead, we are sending $44.9 billion to Ukraine for assistance and $40 billion for natural disaster recovery domestically. They're going to keep sending money to Ukraine until it doesn't really benefit the United States to do so anymore. But for right now, the Ukraine's getting the money. What are they doing with it? Oh, no. Most of the money sent to them was through FTX. And so I'm sure it's not entirely 100% on the up and up, as anything with the government is. People think it's a controversial thing to say, like, oh, you're putting scrutiny on Ukraine? You're putting scrutiny on the Ukraine situation, Dylan? It sounds like you're a Putin sympathizer. I'm not. I'm just a skeptic, as anyone should be. I think, my heart goes out to all of the Ukrainian civilians that are in active war zones and in an active conflict. No one should be subject to that. No one at all. And I generally think that Russia's actions ethically are reprehensible. But that being said, it's not surprising that they're doing that. I don't think anyone is actually surprised that Russia is doing this. And if it really mattered to the people that are actually making the call to send $44.9 billion to Ukraine, they could have added Ukraine to NATO a long, long time ago. They could have added Ukraine to NATO 30 years ago, but they didn't. Why? Why did all of the NATO countries end up voting against Ukraine joining NATO? Because they knew that what Russia's big plan is to rebuild the Soviet Union, and this isn't a spinfoil hat thing. Like, every major superpower wants to be an empire. That's imperialism. America's doing it right now. China's doing it right now. Russia did have superpower status, and I think it's diminished from where it was. But I definitely think they're trying to regain the superpower status. And one of those things is trying to rebuild an empire. It's empire building. And Ukraine doesn't have any protection from NATO. So they are just going to do it. It's not surprising. Reprehensible? Arguably. I generally tend to agree with the people saying that it is reprehensible, but not surprising. Anyway, with this bill, this $1.7 trillion funding bill, most of it's pork. Keep in mind, this is the government, so most of the money probably is going to be squandered, like completely squandered, and it would probably be more productive for them to actually just burn the American dollars than to actually just try to do the funding. But hey, Senate and House passed a $1.7 trillion federal funding bill through September, and it's going to the desk of Joe Biden, which, I'm assuming I'm assuming Dark Brandon is going to sign it. I'm sure Joe Biden's going to sign it. So keep an eye out for it. Obviously, on my Twitter at Real Dylan Holy, you will be the first to find out when that ends up happening, because we stay on top of the breaking news. Always, you already know, at Real Dylan Holy on Twitter. Subtle little plug. Speaking of Congress passing bills, the 401k and IRA changes to consider after Congress revised many retirement laws. Let's take a look. Americans will need to rethink how they save after Congress passed a series of laws that stand to overhaul parts of the country's retirement saving system. The retirement overhaul is part of a larger bill passed by Congress just before the holidays. It includes dozens of retirement policy changes that will go into effect over the next decade. Many of those provisions kick in immediately after the bill passes, however, creating the need for Americans to examine their own financial planning now, financial advisors say. The main changes that go into effect right away include incentives for more employers to offer retirement plans and to encourage workers to contribute, and new rules on taking money out and getting lifetime payouts. Here's a rundown of the key changes that you might want to know. New rules for taking out money, required minimum distributions. The new legislation raises the age taxpayers generally have to start taking required minimum distributions, known as RMDs, from their retirement accounts to 73 from 72 starting in 2023. So basically RMDs, and they already explained it here, but I know that some people are visual learners, so we're gonna let's take a look here. The RMD visual, can we get an RMD visual? There we go. All right. So basically what the required minimum distributions is once you hit a certain age and you have money in your, I believe it's just 401ks. The IRAs, they don't have RMDs. Actually, hold on. I don't want to say that until I get it confirmed. Is it required minimum distributions? Okay, nope. It is okay. It's in all IRAs, so do not. Yeah, so in every retirement product, so 401k and IRAs. Let's say you have some money in there. All right, let's say you have here, $500,000, and once you hit 72, now 73 for 2023, but once you hit 73, you're basically forced by the government to pull money out. You have to pull money out. And these are just some estimated numbers, but once you hit a certain age, you are legally obligated. You have to start pulling money out of your retirement accounts. And I think, I think bumping it 1 year is okay, because it'll give you, if the money is invested into, securities, equities, or anything that is able to compound passively, it will give a further year to compound, which I generally think is a good thing. Giving more time for more of your assets to grow untouched is probably better than less. That being said, it is a warning flag in terms of how prepared most Americans are for retirement, and the fact that we have pushed the RMDs out another year to 73. It's just really worrisome, man. Like, I think it's a good thing. I think it's a good thing overall to allow people to have their assets compound further and not have, a set time when you have to start pulling money out. I think it's good to kick that down the line. But it shows that people are having to retire later and later in America, and that is very worrisome. Speaking of RMDs, there is missed RMD penalty relief. Congress is reducing the 50% penalty for missed RMDs to 25% of the amount that should have been withdrawn. The penalty drops to 10% if it is corrected in a timely manner. So basically, if you're not pulling money out of like the minimum amount of money from the RMDs out, the government's going to fine you. I just think that's stupid. I think there shouldn't be RMDs. I don't like the idea of RMDs, but I don't like the idea of the government telling me, You have to pull your money out here. Now, on things that like you are making the decision to own, you have to pull them out at this time. I don't really like that, but the RMDs are there, and they are and they are reducing the penalty to if you mess up accidentally, which is good. New exceptions to the 10% early withdrawal penalty. Typically, there's a 10% penalty if you withdraw money from 401ks or other pre-tax retirement accounts before 59 and a half. The new legislation enhances several existing exceptions, including covering certain private sector firefighters and public safety officers. It also adds new categories allowing individuals who are terminally ill to make limited penalty-free withdrawals. A catch-all exception, allowing anyone with a personal or family emergency to withdraw up to $1,000 a year penalty-free. That kicks in 2024. The penalty exception for those affected by the federal declared disasters is retroactive to January 26, 2021. There were also exceptions for victims of domestic abuse and payment of long-term care premiums. Hey, fair enough. All right, cool. If you need the money, cool. I think overall this is a good thing. New rules to encourage savings, small employer retirement plan startup tax credit. If you work for a small employer with up to 50 employees that doesn't offer a retirement plan, your company is eligible for an enhanced tax credit to start up a plan as of January 1st. The new credit covers 100% of initial costs up to 3 years, depending on the number of eligible employees. Employers with 51 to 100 employees get a lesser credit. There's an additional credit if an employer also matches employee contributions, available for 5 years. So if employers are, or if there's a startup plan or a startup company and they're trying to get employees and they want to give them some retirement incentives, they are getting a tax credit for it. I think that's a good thing. Good stuff. Solo 401ks under the current law. Self-employed individuals who want to establish an individual or solo 401k plan have to set it up by December 31st to make contributions for that year under the new provision until they file their tax return the next year to open and fund the account, meaning solo entrepreneurs can set up plans during the coming tax season for the 2022 tax year. So it's just giving more flexibility for people to be able to invest into their solo 401k accounts. Again, most of this stuff that is being passed, I think, is generally a good thing. I don't know if there's anything that I've seen. I don't know if there's any negative things. Gift cards. Or actually, no. Let's do the 2,500 rainy day. Emergency savings accounts. The legislation allows employers to automatically enroll non-highly compensated employees, those who make up to $150,000 for 2023, in emergency savings linked to a 401k plan. Employees could save up to $2,500 and withdrawals would be tax and penalty free. Gift cards. The legislation authorizes employers to hand out a small cash payment or gift card to encourage workers to sign up and contribute to a 401k type retirement plan. The idea is that some employees might respond to a couple $100 as a sign-up bonus, says a former Treasury Department official. I think this was needless, personally, but no, the big thing should be, don't give them a gift card. Give me one moment. My cat is eating tinsel. Sorry, y'all. It looks like he was eating tinsel, but now I think he's okay. Now I think he's being taken care of. He's getting loved on by a family member, and I believe his mouth is now tinsel free. Yeah, I think the gift cards, that's a fine idea. It should just be bonuses going straight into a 401k account, but I guess if they want a gift card, give them a gift card, whatever. I guess, again, generally fine. Roth employer matching. This is a big one. This is a huge one. The new legislation permits employers to offer Roth matching contributions into an employee's 401k account. Currently, the employer match money goes into employee accounts on a pre-tax basis, so like a traditional 401k. Under the new rules, employees can now choose to take the Roth match, which means they are able to pay taxes up front and then later take out the contributions and potentially the earnings tax-free. This is huge. So basically, How Roth 401k matches work right now is you have the Roth 401k, which is after you've done all the taxes and fun stuff like that, and anything the employer adds is still subject to tax later down the line. And this new type of Roth employer matching, everything, or you can elect to have the taxes be paid up front, and then you can pull it out like a normal Roth IRA, like a normal Roth IRA or Roth 401k. This is huge. As someone who has a Roth 401k, I will be switching to it once I get that option. No question. Again, not financial advice, just complete transparency for transparency's sake, because you know that Dylan Holy of the Dylan Holy Experience will always tell you the most transparent things that I am willing to let you all know about myself. Obviously, there are some things out that we like to keep private. But no, in most cases, I will always fill you in on anything financially that I do, because I have no idea what's going to happen with my financial life, with my financial career, and we're documenting it. So anyone who may be confuzzled about stuff, they can take a look and maybe not look at it as advice, but be able to just use it as a jumping off point. Obviously, everything is entertainment purposes only. I'm just a kid on the internet. I'm just a 20-year-old on the internet playing a rich old man's game. So we'll see what happens. The rest of these are are just some charitable rollover provisions and deferred annuities. These are mostly for boomers. You can buy annuities. You'll be able to make more money if you buy the annuities. And this is you can if you have an IRA and are 70 and a half or older, you can take a one-time withdrawal of up to $50,000 to fund a charity gift on a trust. I don't think many people are going to be taking advantage of these two down here for the lifetime income provisions, but I definitely think the Roth employer matching is huge. The 2,500 rainy day fund it's important. I don't know how many people are going to take advantage of it, but it's still very nice. The tax credit and the solo 401ks for the startups are huge. This is big stuff. The withdrawal 10% early penalty, that one's pretty solid for anyone who does have to pull money out for hardship reasons. And of course, the RMDs, both the increase in age and the missed penalty relief are both pretty massive. So I think overall, these changes that are being made to the 401k and IRA, I definitely think are overall good things. We're in the 21st century, all right? And I think that the 401k and IRA infrastructures were pretty dated, and they're starting to modernize them. I think that's a really good thing. And I'm looking forward to taking advantage of some of these new provisions being passed. Lastly, ladies and gentlemen of the millions, it is Christmas Eve. So one thing and one thing only, Santa Claus is delivering his gifts right now, making Christmas and holiday magic happen right now. He is in Venice, Italy. He will be departing in less than 20 seconds. And right here in California, Santa Claus will be here in about an hour and a half. So those of you on the West Coast, keep an eye out in about 11 and a half hours, and he will be here. I have a family Christmas Eve dinner to be attending, and I believe you all have a place to be attending as well with your loved ones. Hopefully, if not, you have some lovely plans for Christmas Eve, Christmas, Kwanzaa, anything that you celebrate. Thank you so much for watching the Christmas Eve market recap. I guess we can do some subtle plugs right now. Twitch.tv/RealDMH. I'm sure that's where half of you are watching all of this hijinks play out. The other half, I'm sure, on youtube.com/@DylanHoly. So if you haven't already, be sure to follow on Twitch. I don't have a subscription button yet, but there will be one soon, possibly on YouTube. You already know we have a subscription button, youtube.com/@DylanHoly. We post content up here. We're always streaming, at least on Wednesdays, sometimes over the weekend. And of course, twitter.com/@RealDylanHoly. So my Twitter handle @RealDylanHoly. You will always be the first to find out when we are going live with the Dylan Holy Experience. And of course, the quintessential of Real Dylan Holy @DylanHoly on Twitter. the key takeaways. So every single day the market is open, we're always giving key takeaways on news and events that play out in the market. You're always the first to find out on any news that's being talked about. In fact, this what I'm talking about, that $1.7 trillion funding bill, I talked about this yesterday on Twitter. We talked about all of this stuff like 2 or 3 days ago on Twitter. So if you want to stay up to date on anything that's happening, at Real Dylan Holy on Twitter. And there we go. I believe that's everything for the Christmas Eve market recap. You all have a fantastic next 2 days, a fantastic, happy holiday time. Hopefully it's everything that you could wish for. And I'll see you next week. You have a good one.